Parts performance monitoring. We've now reviewed how the dealership's fixed operations fits into the overall automotive aftermarket and the challenges market competition poses. We have reviewed the 5 major issues in parts operations management, why they are important, and how to apply them when inevitable trade-offs need to be balanced. We've had an overview of parts operations financial analysis, the financial statement sections that provide the necessary numbers, and have developed the various key financial performance measures that need to be evaluated against acceptable benchmarks. We have in detail examined the cross-section of key performance indicators, or KPIs, that are used in advanced inventory management. And finally, we have in equal detail looked at the capabilities of major dealership management system, or DMS reports, and how they are used in inventory management and control. In this chapter, then, we will pull all of these pieces of information, or hopefully knowledge, together into a rigorous process of consistent parts performance monitoring. Now here's how we will proceed. Become familiar with a rigorous parts monthly evaluation checklist. Chapter 6 uses an evaluation checklist format that has become a recognized industry template. I've modified it and updated it to be most useful in our setting, but it is an accepted rigorous analysis. Second, recognize the core issues in tracking parts department performance. 3, apply a broad set of measurements to parts performance management, and they may include operating, financial, and operating procedures. And 4, critically appraise performance with the use of guidelines and benchmarks. And the guidelines that I use in this discussion are generic industry guidelines, where some current, recently issued guidelines may be significantly different. I'll point out those differences. And 5, develop suitable action plans based on unfavorable variances identified. Now, I'm heading this with time-honored wisdom from management. One of the grand old men, or elder statesmen among management thinkers, Dr. Peter F. Drucker, popularized 2 maxims of management thinking that have become the foundation of the management function of control. You cannot manage what you cannot measure, and what gets measured gets done. And this means setting SMART, S-M-A-R-T, remember from chapter 3, specific, measurable, achievable, realistic, targeted goals and objectives that are tightly integrated into a management by objectives, or an MBO control system. And how is that done? Well, measuring performance. First, you need to nail down what performance is, then measure the performance, then comparing actual performance against guidelines, and then 3, taking action to correct unsatisfactory variances. And what gets measured gets done is particularly poignant, because when your staff knows that you're paying attention to some specific performance areas, they will usually try to make sure they shine in it. Now, this is our Parts Department Monthly Evaluation Checklist. That's the heading here. I'll review each of these 36 checklist items in summary form first here with the aid of this slide. And Chapter 6 has a 10-page interpretive key, quote unquote, which defines each of these 36 items, and I'll spend a bit of discussion as we are progressing here what some of these definitions mean and what should be emphasized in those definitions. And the first number here is total part numbers controlled. That's in numbers, and total controlled inventory dollars. And there's a reconciled inventory, and I'll come back in the next slide what reconciling means here, because we've observed that the DMS and the financial statement inventory dollars are usually somewhat different. They're rarely identical. Okay, so reconciled inventory. Then non-stock part numbers, and that's in terms of percent in the numbers and terms of percent. Then non-stock stock dollar value in dollars and in percent, then gross sales, and that's annual gross sales to become meaningful numbers, so you have to annualize them if you're not using a full year statement, and gross profit annualized and cost of sales annualized, and then gross profit margin, which is the gross profit percent earned on sales. And then inventory from financial statement in dollars, and that's the actual inventory cash value from the general ledger. And then LIFO reserve if used, and that's a particularly interesting category that is in Canada going away, but it's still used in the US, and some of the Detroit 3 manufacturers still use it in their standard financial statement. Gross turn ratios, purchase efficiency, and this is sort of the stock order performance, and purchase efficiency in the just-in-time setting, and there's for regular stock orders, for other sources stocks, so in other words there are a couple of categories, and a utility line for whatever you might want to add there to track for total purchases, and then for stock, and then purchasing stock order performance or efficient purchases divided by the cost of sales. Then true turns, stock order performance multiplied by gross turns. That's another way to get true turns, and I'll talk about that. Excess stock, true excess stock, which factors out the automatic phase-out parts, then parts 6 months no sale in dollar value, then all parts 6 months no sale in percentage, then parts 12 months no sale in dollar value, parts 12 months no sale in percentage, then new parts no sale, which for some reason are on the shelf and they have some quantity but no sale, and have recently or in the last 12 months been entered for total demand in pieces, emergency purchases and customer orders in pieces, lost sales in pieces, and then level of service calculated with pieces, and that's the demand filled from stock ratio in pieces. The level of service can be calculated in all three pieces, number of parts and dollars, but in pieces to compare with a filled from stock ratio, which must be calculated with pieces. Months and days of supply, rate of change, things phased out and phased in, operating profit as a percent of sales, personnel expense and productivity of parts personnel, and that's that monthly sales per employee per month, and then the absorption rate that we've discussed in the financial analysis section, and service productivity is an added item that's usually considered relevant in parts evaluation because depending on how the shop parts counter, how efficient it is, and the fill rate that it generates there directly affects technician efficiency. Okay, that's the overall discussion. You may, as we are looking at the individual items, let me suggest that you may wish to keep your textbook open to the full page of this checklist in order to better follow the more detailed interpretive key discussion. Now, I talked in the context of 2A reconcile inventory about the need to reconcile the inventory between financial statement and DMS. I've said in different contexts that the inventory dollar amount on the current asset side of the financial statement is rarely the same as the inventory investment on the DMS. And here is why. Have many adjustments that could feed into it, any or all of those. Dollar value per DMS, that's the replacement value as currently priced. Dollar value of non-computer controlled parts that may be in the financial statement but they're not controlled in the DMS. Dollar value of parts on repair orders that have not been closed out and therefore have not been taken out of inventory. Dollar value of core charges in the DMS. Dollar value of defective core charges that can't be returned, for example. Dollar value of damaged parts claims that have to go to the supplier perhaps or to the carrier. Dollar value of pending credits, returns, cores, etc. And that is the adjusted dollar value of parts department inventory. Now that's on the parts department side. And then dollar value of general ledger actual case value of appreciation, depreciation, which are adjustments which have perhaps at this point only be done in the DMS, not on the financial statement, dollar value of handling charges, COD specials, discounts, negative on hand, plus minus adjustments, in other words sales already completed but we didn't have the part to sell until it comes in, negative on hand, items invoiced not received, dollar amount of unrecorded payables, dollar amount of amounts payable, reconciled items, adjusted dollar value of parts ledger, then dollar value of parts differences, over and short, and that gets me to the revised dollar value of parts general ledger. Okay, now this reconciliation should be done periodically to satisfy ourselves that we are within the plus minus 2% acceptable range. If we are way out, then somehow that implies that some of our tracking of our comparative entries may not be done rigorously. Okay, now we get to the respective accounts of the checklist and one by one. And first one is part numbers controlled, and that is the list of part numbers monitored by the system. Second is total controlled inventory value, and that's the inventory replacement value currently shown in the DMS, and the inventory replacement value is determined by the costing method used, and we'll get to that in item 10. A third item is non-stock part numbers. The guideline in terms of numbers being tracked for this figure is 30 to 50% of line item 1 of the part numbers controlled, so up to half of those, or in some cases I've seen even greater numbers. 4 is non-stock dollar value, and that's the dollar value of non-stock parts. The guideline for this is 5% of line item 2 of the controlled inventory value. Let me say for this, where applicable, the guidelines provided reflect a consensus of a representative group of industry experts. In other words, I've sort of compiled and summarized and averaged some of these guidelines. Again, when materially different, be sure to get franchise-specific guides from your respective source, because there may be a reason why your dealer network is different. And ask your field rep. That's usually a good place to start. What do you have in terms of best guidelines? Now, for line items 5 to 8, and they're coming up on the next slides, these are sales and cost of sales numbers and gross profits. They must be annualized to obtain guideline data that is recognized within the industry, and that's an important consideration. So let me move into these items 5 to 8, and they are gross sales annualized, and that's year-to-date gross sales divided by the number of months of the statement multiplied by 12. Okay? Depends what statement you're looking at. If it's the June statement, you take gross sales on DMS. If it's a June report, then divided by 6 multiplied by 12. Same applies to gross profit annualized. Gross profit is reported in the financial statement, so it would be annualized gross sales minus annualized cost of sales. And cost of sales, that's the next one. That's sales minus gross profit equals cost of sales. All of them annualized, divide by the number of months of your statement that you're looking at, multiply by 12. Okay, then item 8 is gross profit margin, and gross profit margin is calculated by the dollar amount of gross profit divided by sales. That is for the general parts department 28 to 35%, and that means for all account subcategories combined. There may be a reason why someone is at the lower end of that range if there's big wholesale, etc., but that's the gross profit margin total department. And then inventory financial statement, the actual cash value of the inventory as shown on the balance sheet. Now, we get to a kind of a complex category. Item 10, LIFO reserve, if any. And I've specifically referred to chapter 3, pages 311, 312. LIFO costing is not GAAP, generally accepted accounting principles, compliant in Canada, but some manufacturers still use it. Item 10 is often misunderstood and deserves special emphasis. So let me elaborate a little on that. And it's kind of a long-winded discussion, but it's important to understand that. Generally accepted accounting principles, or GAAP, require inventory to be recorded at the lower of cost or net realizable value, quote unquote. This is what GAAP says, which for a regularly moving active part will be the purchase price or the dealer net price of the part. Depending on DMS settings used, the change in inventory values stemming from a purchase price increase or decrease is either debited or credited to the inventory account, or sometimes accumulated in a separate net appreciation depreciation account. Where pricing updates, and this is important, where pricing updates to the parts master file are simply allowed to update the dealership's master price list, the cost of sales value for a specific part will not be the original purchase price of that part, but the current dealer net price of that part. It'll update everything. Okay. Now this practice represents so-called LIFO, last in, first out inventory costing, which is no longer accepted accounting practice in Canada. It is still accepted in the US, and as a result, at least one Detroit 3 manufacturer I know of, its standard accounting format recommends that parts master file price changes update all dealer parts cost and to reconcile the net inventory value change to the adjustments parts and accessories inventory account. So you may still see the practice in Canada. Others may record the net appreciation depreciation as a LIFO reserve, and that's what's shown here, presumably to be reconciled by year-end adjusting entries when the year-end is closed out. GAAP-compliant inventory costing methods in Canada include both FIFO, which is first in, first out, and the more commonly used weighted average costing. These methods will retain on file the dealer net price at the time of purchase and clear inventory in the order of historic cost. Okay, so this is quite a mouthful. Why are we having this lengthy discussion about inventory costing? Well, inventory cost is the parts department's cost of sale. If a parts master file price update therefore increases the dealer cost to the last in price, cost of sales will correspondingly increase and gross profit will correspondingly decrease. As a parts manager, you'd want to be aware of this reality if any performance pay or incentives are tied to gross profit dollars or margin, because it affects gross profit. Okay, now move on to the next, gross turns ratio, and again that's done on an annualized basis. For dealers on a daily stock order or just-in-time system where you can submit daily stock orders, for over 2 years is 5 to 8 turns, and that specifically, let me make some reference to this over 2 years. I'd indicated when we talked about advanced inventory settings, then you should, for example, to the day supply settings, you should not make dramatic changes because it distorts a whole number of reports. You should do it gradually, and this is where this suggestion comes from. It takes a while to get to a given level of best stocking level and best reorder point with incremental changes, and once you've been on the system, if you've switched from a weekly stock order to an open daily order system, it takes about 2 years for this full effect to be stable. For dealers on a weekly stock order, 4 to 6 turns, and just-in-time order, 5 to 8 turns. Purchase efficiency, and that is, or stock purchases is the second line here. Stock purchases in the weekly stock order setting, again annualized. Purchase efficiency is what we call it in just-in-time setting, because often there is no specific stock order, that's just efficient purchases. There are separate categories in these items 12 to 16 for daily or weekly stock orders to the manufacturer, because that's clearly your bread and butter. Purchases from outside suppliers for stock on a regular basis, which may be from another dealer or maybe from a local parts wholesaler for used vehicle reconditioning, for example. Then foreign parts purchased on an as-needed basis. Whatever you define for an as, it may be a wholesaler purchases from another manufacturer or whatever, and a utility line. That's simply an additional line if you want to track one additional item in that purchase efficiency category, and then total purchase for stock summarizes lines 12 to 15. So that then gets me to line 17, and that is total purchase efficiency, which is total purchases for stock, and they may be efficient purchases or actually called stock purchases, divided by annualized cost of sale, which is the total movement of parts through. So which proportion of those was for stock? A good guide is 85 to 90% on the daily stock order, 80 to 88% for the weekly stock order, because if we have marginally longer lead, or significantly longer lead times, frankly. Okay, so that is the total purchase efficiency. Now we get to the true turn ratio, and when I discussed the checklist, I said that there are two ways really to arrive at that ratio. That one that we have discussed in advanced inventory management is total purchases for stock divided by average inventory. But really you can do it by taking the gross turn ratio, which is determined by your total investment basically, and total cost of sales, and multiply it by the purchase efficiency that we've just calculated, because that then reduces the cost of sales to that portion of cost of sales that was purchased as efficient purchases. So there are two ways of doing it, and that's shown on the checklist. A good guide, 5 to 7 per year on the daily stock order, 3 to 5 per year true turns in the weekly stock order. And there's a specific parenthesized comment: automatic stock replacement systems will often exceed 9 per year because they're very rigorously monitored on an ongoing basis, and that's like the RIM system, for example, that General Motors dealers tend to use. Now, I emphasize again, these are minimum desired results. Guidelines will vary by manufacturer. This is kind of a compendium of what's out there that I've summarized. Next is total excess stock, item 19. We define that as stock where the on hand plus the outstanding on order quantity, either back order or outstanding orders, is greater than the best stocking level, or some systems call it the max or the high guide or whatever, but that is the best stocking level. Okay, a good guide is less than 25% of total on-hand inventory value, particularly trended. Look at what you see, because you may see when the manufacturer has some special seasonal promotions at significant discounts, and I bring additional stock into my inventory because it's profitable to do that, then the trend will show that's typical during that period when excess stock increases. Now, all obsolescence is emphasized here is excess, but not all excess is obsolete. Why? All obsolescence by definition is stock I shouldn't have, so it's excess. But excess stock, we know, is often created intentionally because of bulk buying or multi-pack quantities or seasonality or fluctuations in demand. Okay, so that's total excess stock. Now there's a memo item below total excess stock in the checklist, and that is 19A, true excess. And that's total excess stock minus those parts that are greater than 6 months no sale. And these are parts that are basically technically obsolete, and it deducts those from the total excess. And then the guide, because there's usually a significant amount of those sitting in the mix, and so that then purifies the true excess, and that should be less than 10% of total on-hand inventory. And again, you should look at it on a trend basis, because that may identify why it's happening and at what point in time. Next is the inventory greater than 6 months no sales, the dollar value. There isn't necessarily a guideline for that. The best stocking level is recalculated monthly, so some of this inventory will cycle in and out of the 6 months no sale category. In the standard setting, those parts will have moved to the automatic phase out line, but I may have some demand fluctuations. As I mentioned, I may have normally 20 pieces of demand a month for a given item, and for some reason this month I had just 5. So the month-end EOQ calculations of the inventory management system would say, well, now I have excess stock based on this new average demand that I'm getting. Okay? That's dollar value. Inventory 6 months no sale is percent of the mix. We've identified that as technically obsolete, less than 35% of total inventory investment. That's the percent of mix. And then 22 and 23, both in dollar value and in percent, show inventory 12 months no sales, and that is absolutely obsolete. In most cases, and we've emphasized that many times, the accumulated holding cost exceeds the profit made on the part, and that should not be on the shelves. A guide is less than 5% of total inventory value, and on a daily stock order system, less than 5%. Toyota says less than 2%, as we've emphasized, less than 10% of inventory value in the weekly stock order setting. Then let's move into item 24, and that's new parts, no sales. And that's kind of an interesting category. These parts have 3 things in common and can only enter this category when first placed in the inventory system. And the 3 things they have in common: 1, the entry date is less than 12 months. In other words, it was during the current year that's been entered. The on-hand value is greater than 1. In other words, something is in stock on those parts. And 3, there is no sales history for these part numbers. So I guess that then raises the question, if there's no sales history, why the heck are we stocking these parts? Well, there are a number of reasons why we might be stocking it. A special order that has not been picked up. There was some part that I've never had in inventory. I've never had it listed as a non-stock part, and that probably is questionable whether that should have been happening. It should probably have been entered as a non-stock part. But if that didn't happen, because it's something that I consider not a repeat order, then it could be a special order that has not yet been picked up. Secondly, manufactured recommended stocking kits or packs. It's common in the industry when a manufacturer introduces a brand new model that has, let's say, a whole host of brand new parts, that they send you an original stocking kit. That is manufacturer's best take on what kind of parts should be required over the next a few months to a year. And that usually has some special criteria attached to it. Most manufacturers say whatever hasn't moved in whatever period, let's say 180 days, you can return those parts without having to use up your obsolescence accrual allowance to return them, and there might be other conditions or qualifiers attached to that. Guide value is less than 5% of inventory value. Now, this checkpoint, let me make this point, has the potential to be a looming crisis. It therefore needs to be monitored very carefully, and this is why the last red paragraph here. The major monitoring purpose is to ensure that these parts didn't enter the system as a result of speculative buying. And speculative buying, we have been saying, is the kind of stuff, well, there's a bunch of new parts being introduced. Let me bring some in to see what happens. That is a recipe for excess stock and obsolescence. Don't get involved in that. That's why it's such a crucial measure. Now we get into the next item, total demand, and that's gross sales plus lost sales in numbers, dollars, or pieces. These are the 3 categories. We've identified that. Emergency purchases or receipts, and that may include customer special orders placed at stock. And how could that happen? Well, maybe a customer special order just came in, the service department said we need this part. It's not something we normally carry, but because we are just about ready to submit our stock orders, we add that to our stock order. It really wasn't a stock order, it was a special order, but that's that qualifier. Now, general guide, 10 to 15% of all orders. Now, lost sales. Lost sales, there's three kind of lost sales, and it's a bit of a subtle definition. There's lost sales based on availability, and that category itself, that item 1, has two potential causes. One is lost sales on a non-stock part that I never had in inventory. The customer wasn't prepared to wait for that part, so I lost that. Okay. Second one may be lost sales, and that's a more critical one. Lost sales on a normally stocked part. It is an active part, but for some reason I was out, and that usually is a problem with monitoring it, and I couldn't fill that sale. The customer says, no, I'm not waiting for tomorrow morning. If it's in a just-in-time order system, I can go to Part Source. I know they have it. Okay, so lost sales based on availability. Second one is lost sales based on the cost of parts, and that's less an inventory management issue than a pricing issue. Somebody calls in, say, I need XYZ part, how much is that? And I say $121 or whatever, and say, whoa, I know Canadian Tire or whoever or some other supply source has it for $92. No thanks, I'll get it there. That's more of a record to keep to see if we are competitively priced, and should probably be fed back to the manufacturer in prices, or maybe my own markups that I decide to use in my pricing system. And the third one, and that's a subtle one, because increasingly we're doing electronic online buying, and websites that use those electronic locator systems, because if somebody goes in there and decides, well, that doesn't show an inventory and just disappears, we really don't know that we could have lost the sale there. So that's a bit of a subtle one, and that obviously there might be different solutions in different settings. The general guide for recording lost sales, and most people that I've checked with said that on average in a reasonable mid-size and larger dealers, 2 to 3 lost sales per person per day would probably be entered into the DMS. And so it is some significant potential revenue forgone. And a key point is the last paragraph in red. It is less the existence of lost sales, because everybody has some lost sales, but the absence of them that should concern dealership management. If we don't have any lost sales, that's in reality not possible. It usually means the part staff is simply not tracking lost sales, and that's a crucial omission, because that then means that lost sales will continue instead of our being in a position to adjust our inventory to make sure that we eliminate lost sales to the extent possible. That gets us to the level of service, and the first one, level of service, is that calculation that can be done using either part numbers, pieces, or dollars, and that's cost of sales minus emergency purchases divided by total demand, which is cost of sales plus lost sales. And the second level of service, and that's really the more relevant of the two measures in terms of availability, is filled from stock ratio. Total demand, and what it does is add lost sales in two places in the numerator, because total demand is cost of sales plus lost sales. So total demand then minus the sum of lost sales plus emergency purchases plus special orders divided by total demand. And this here, I remind you, must be done in pieces. That's the only relevant measure there. And the guideline for filled from stock and service level also in most cases is 85 to 94%. Okay, and make sure when using total demand, net sales plus lost sales, if it comes from the DMS, it will be at cost, but if that total demand comes from the financial statement, it is at a different pricing level and has to be reduced to cost of sales. And we get into months and days supply. Total inventory from the financial statement divided by the average monthly cost of sales. So calculate your cost of sales divided by the number of months that represents, and that will tell you your average months or day supply. In this case, months, because it's monthly cost of sales. If I want to do it in days divided by the number of days, that's somewhat harder to average because of different number of working days per month. So it is really just a ratio, not an indicator of effective performance, but it is a corroborating measure for true turn, and that's what's said in the line below, correlated with true turns. As months supply go down, in other words, the numerator declines, true turns goes up, because that's the kind of direct correlation. Then rate of change, total parts added in months, total parts deleted, so additions and deletions, multiplied by 12, and that's if it comes from the current month's DMS report, then multiply it by 12, total number of parts tracked in the system, and that was the line 1 on the checklist. This measure can fluctuate widely, but it provides indicators that show whether the parts department is tracking the flow of all part numbers in active inventory and eliminating those that have become obsolete. In other words, there is a constant change. There are additions, deletions that deal with either redundancy or with new demand that requires additions to inventory. Then 32 is operating profit. And operating profit has two core measures. Operating profit as a percent of gross sales and operating profit as a percent of gross profit. These are the two guidelines, and really the only thing that's different is the denominator. Both have annualized operating profit in the numerator, annualized gross sales in guideline as a percent of gross sales, annualized gross profit in the denominator as a percent of gross profit. Is the calculated result optimal? Well, consider the following. Does the parts manager have control over all allocated expenses? And that we've discussed in the financial analysis section. Many of the shared expenses are strictly allocated according to some formula. Is it fair to be critical of the performance if the manager really doesn't have much control over expenses? Because remember, gross profit minus expenses equals operating profit. The parts manager certainly controls in every respect gross profit, but the allocated expenses affect operating profit, and that may or may not be fair to measure at that level. If there's too much that's simply put in, if the parts manager doesn't participate in the budget decisions where those allocation decisions are made, it probably is unfair to be critical of that performance. Second, does the revenue mix explain variations from typical guidelines? And the revenue mix is on the top side. Sales minus cost of sales equals gross profit. If the sales are made up to a large degree of highly discounted sales, well, that would then suggest the gross profit is lower, and that feeds directly through at the given level of expenses to operating profit. So there's a number of things that should be taken into consideration when you're looking, is this number acceptable within that range? Now, we get to 33, personnel expense. The national average is usually between 40 to 50% of total departmental, in other words, total parts department expenses. And these numbers can vary significantly between regions and dealer-specific marketplaces. And the reason for that is the cost of living varies widely among geographic regions in Canada. So be careful if you're looking at a high labor cost region. That clearly affects personnel expense. Parts productivity, and this is this number of total part sales per parts employee per month. The calculation is annualized gross sales divided by 12, or whatever number. It's annualized is more meaningful, but you can, if you have a 6-month statement, you could just divide it by 6. divided by the total number of parts personnel, and that includes the parts manager. So the normal guideline would be 35 to 40,000. This varies by manufacturers and the revenue mix, and I simply emphasize that by saying we've already said to the 2015 just released Toyota dealer operating guidelines now say $65 to $80,000 per employee per month. This is a startling change. So you may want to run this by your manufacturer's rep to see if it has changed as dramatically in your dealer network. But certainly that $35,000 to $40,000 is still a generally accepted number. That gets me into the last two numbers here, and that is the absorption rate. It's the annualized gross profit from service, parts, and body shop departments. So the total fixed operations gross profit divided by the annualized total fixed overhead expenses. And if you go to the financial statement to total operations, the top part usually has a series of variable expenses. They're from the sales department, like sales personnel compensation, which is directly variable with the number of units sold. This is about total fixed overhead expense. So if you take it from the bottom line of total expenses, make sure the variable expenses are deducted from that. A common guideline is better than 75%, or better than 90% with a body shop, because more of the facility is used. That increases absorption at a given facility expense. Now, we've said absorption rate is the most important measure of long-term stable dealership profitability, because the higher that absorption rate, the more stable the earnings flow, because sales or the variable operations, the sales departments and F&I fluctuate widely usually and have quite cyclical sales patterns. And the final number is service productivity. And why is service productivity included in the parts checklist? Well, since the majority of part sales are through service department repair orders, your efficiency as a parts department of parts fill to the technicians directly affects this number. And this is usually relevant over a period of time. Certainly, guideline is better than 100% in flat rate shops where there's a tremendous incentive to produce, because pay is directly linked to the number of billable hours produced. It's up to 110 to 125 is in fact a reasonable guideline in the service side of the business, but better than 100%. And that tracks our parts availability trends that we see affecting service productivity. That is an important consideration. Okay, that gets us then back to that overall sheet that shows the complete checklist. There are other measures that can be added to the checklist if they are relevant to your management control effort, but note that this is a snapshot of a single month, in which this is a month-end checklist. When comparative monthly data, as you're producing these monthly sheets, is then tracked with the aid of a spreadsheet, the direction of the trend is infinitely more important than a single month. So I strongly encourage you to, as you're doing month-end checklists, to enter those into a spreadsheet to track them over time. So this then wraps up the sweeping examination of financial and inventory management practices, what we've done in chapters 2 to 6. What remains in this course is facility equipment and organization, that's chapter 7, and then marketing and merchandising, and that's chapter 8. They deal with building the capacity for a professional operation and the pursuit of growth and opportunity. So stay tuned.